The markets climbed well off their lows after Washington passed a massive government spending plan and the Fed promised to help rescue struggling businesses. But the crisis isn't over yet. Joining the panel, Global Chief Investment Officer at Guggenheim Partners, Scott Minerd. Scott, I'm going to come to you in a moment. I just want to ask Ben first. Ben, the subject of our cover story is the difference between hope and reality. What can you tell me about that?
Basically, we had a lot of hope this week, hopes fulfilled. And we had the Fed launch this massive monetary stimulus program. We have the Senate and now the House, it looks like they're going to pass this fiscal stimulus program. We have talk of maybe coming back to work and getting our lives back to normal. But there's still so much that needs to be done, both to bring the disease under control and to get through this period where the economy is going to be shut down. And we looked at that and what it means for the markets.
Okay, Scott, you were ringing alarm bells about coronavirus back in February, and your concerns about the market have proved prescient. What is your updated view of things from here?
Well, given the price action of the last week, it's not surprising. We've had a very hard sell-off. I believe what happened is with the news from the Fed on Monday morning, and then the Senate action, that the shorts covered. Once the market stabilized, we see big rotation with people rebalancing from bonds into stocks, which is causing people to liquidate bond mutual funds and to buy stock mutual funds. That rebalancing is almost all played out. So, I would say there's hardly anybody left to buy the stock market at this point. And the news isn't any better than it was last week.
Scott, you've warned about the dangers of bottom fishing. Is there anything you could tell our viewers about what a true market bottom would look like, or just other things to look at in the market over the next few weeks, few months?
Sure. One of the things that market bottoms are always associated with is capitulation. And capitulation is nothing more than, find me a bid at any price. The stock market didn't really get to the levels we would typically think of as a capitulation in a recession. That would be an area maybe between 45 and 55% from the top. But more telling was the bond market. Even after or before the Fed's intervention, large parts of the bond market that were not receiving support from the government, were not trading in line with where spreads were elsewhere. And for instance, one example would be collateralized loan obligations. When oil was last trading at $26 4 years ago, mezzanine tranches on collateralized loan obligations were trading at 40 cents a dollar. Today, they're trading at 70 cents a dollar. That's telling me that we really don't have the panic selling that you would expect in a capitulation in fixed income.
When you talk about the action of the bond markets and the peak to troughs and capitulation, is this a financial crisis? This is like a health crisis. You were early in that. So, what are you looking for? How can you invest through something that really none of us have experienced?
We have about 30 seconds, Scott.
Well, I think that, look, the first thing is to look for valuation. Valuation is still rich in most markets, and valuation is a poor timing tool. So I think you look for value, and then after that, you look to find panic.
Scott Minerd, thank you very much.